When Genius Failed, The Rise and Fall of Long-Term Capital Management by Roger Lowenstein. Picture this. It's a Wednesday afternoon in late September 1998, and you're standing in a room on the 10th floor of the Federal Reserve Bank of New York. This isn't your average conference room. The walls are decorated with old oil portraits of financial legends who seem to be judging everyone with their stern gazes. But here's the kicker. The most powerful people on Wall Street are crammed into this room right now, and they're sitting on cheap folding chairs. Yeah, you heard that right. The heads of Goldman Sachs, Merrill Lynch, J.P. Morgan. These are the folks who usually snap their fingers and move billions of dollars, and they're squeezed onto uncomfortable metal chairs because the Fed didn't have enough fancy leather ones. Why are they here? They're not bailing out a country or dealing with some international crisis. No, they're here to rescue a single hedge fund, a tiny, secretive investment firm from Connecticut that most people have never even heard of. It's called Long-Term Capital Management, and it has fewer than 200 employees managing money for just 100 super wealthy investors. Here's what makes this wild. This little fund is run by a group of academics so brilliant that everyone called them the geniuses. Two of them even won the Nobel Prize. They genuinely believed they'd discovered the secret formula for making money without risk. And for 4 amazing years, they seem to have cracked the code, earning returns of over 40% year after year. But now, the geniuses have spectacularly failed. Their supposedly foolproof formula has backfired so badly that they've lost more money, more quickly, than anyone in financial history. And their collapse threatens to take down every major bank in that room. Today we're diving into Roger Lowenstein's incredible book, When Genius Failed. This isn't just a story about money or fancy math. It's a timeless tale about pride, about the dangerous intoxication of believing you're the smartest person in the room. By the time we're done, you'll understand something powerful about how the world really works. No amount of intelligence can protect you from the wild, unpredictable force of human nature. Every epic fall starts with an equally epic rise, and the story of long-term capital management really begins with one man, John Meriwether. Now, Meriwether wasn't your typical Wall Street hotshot. He was quiet and unassuming, raised in a tight-knit Irish Catholic neighborhood on Chicago's South Side. He was smart, especially with numbers, but he wasn't some child prodigy. His real passion? Golf. He was so good that he earned a caddy scholarship to Northwestern University, his ticket out of the old neighborhood. But Meriwether had an interesting quirk. He loved to gamble, but only when he was absolutely certain the odds were in his favor. He'd even check the weather forecast for Wrigley Field before betting on a Cubs game. Cautious, calculating, with a poker face that revealed nothing. These traits made him perfect for bond trading. He landed at the legendary firm Salomon Brothers in 1974, right as the sleepy world of bonds was transforming into a high-stakes casino. And in 1979, he had a revelation that would define his entire career. A small firm was collapsing because of a failed arbitrage trade. Now, arbitrage sounds complicated, but it's actually simple. Imagine you see the same sneakers being sold at 2 different stores for slightly different prices. Arbitrage is just buying the cheaper one and selling the expensive one at the same time, locking in a risk-free profit. This firm had been doing that with bonds, betting that the tiny price gap between 2 similar bonds would close. But for some weird reason, the gap didn't close. It got wider. The firm started hemorrhaging money and had to sell. Meriwether looked at this trade and saw opportunity. He was absolutely certain the price gap made no sense. Eventually, logic had to prevail. He convinced his bosses at Salomon to take over the losing trade. For a couple of nerve-wracking weeks, the gap kept widening, and Salomon kept losing money. His boss warned him, "We better come out ahead, or you'll be fired." But Meriwether didn't flinch, and just as he predicted, the prices snapped back together. Salomon made a fortune. This moment taught John Meriwether a lesson he'd never forget. Spreads always come back. If you're right and you have enough capital to ride out the temporary pain, the market will eventually prove you right. He was put in charge of Salomon's new arbitrage group, And he had a revolutionary idea. While the traders around him were loud, gut-driven guys who traded on instinct, Merriweather wanted to do the opposite. He wanted to eliminate emotion and guesswork. He wanted to turn trading into a science. So he started hiring a completely new breed of trader, nerdy academics with PhDs in math and economics from places like MIT. Wall Street called them quants, and most firms kept them locked away in research departments. But Merriweather put them right at the heart of his trading desk. These guys were different. They didn't see the market as chaos. They saw it as a complex system governed by logical rules. They built sophisticated computer models, analyzing decades of price data, searching for tiny inefficiencies where the market had made a mistake. One of the brightest was Lawrence Hillenbrand, a socially awkward genius who spoke in precise, mathematical sentences. If a trade started losing money, Hillenbrand wouldn't panic. He'd coolly suggest doubling the bet. Backed by their models, they felt invincible. As long as they had enough capital, they believed they couldn't lose. Merriweather built a protective fortress around his team of professors. They became a family, known as JMS guys. They golfed together, vacationed together, and gambled together on everything from horse races to liar's poker. Merriweather wasn't just their boss. He was their protector, their patriarch, and he instilled in them fierce loyalty and deep secrecy. It was them against the world. For over a decade, this group was Solomon Brothers' secret weapon, generating enormous profits. But their insular, arrogant culture eventually led to disaster. In 1991, a scandal involving one of Merriweather's traders exploded. Even though Merriweather had reported the problem to his superiors, he was forced to resign to save the firm. It was a public humiliation. At 45 years old, the king of bond arbitrage was an outcast. But for Merriweather, this wasn't an end. It was a beginning. He was bitter and wanted vindication. He decided to rebuild his team, but this time on his own terms. He'd create his own firm, an independent fund, bigger, smarter, and more powerful than anything Wall Street had ever seen. He'd call it long-term capital management. To launch the most ambitious hedge fund in history, Merriweather knew he needed more than just his old traders. He needed prestige and intellectual firepower that would blow away the world's richest investors. He needed mystique. So he went straight to the top of the academic world and recruited two living legends, Robert Merton of Harvard and Myron Scholes of Stanford. To understand the sheer power of having these names on your letterhead, you need to know what they represented. They weren't just professors. They were the architects of modern finance. They'd seemingly turned the art of investing into a science. They developed what became known as the Black-Scholes model, a groundbreaking formula for pricing financial options. In 1997, they'd win the Nobel Prize for this work. Their theories were built on a seductive idea, the efficient market hypothesis. This basically says market prices are always right, because they instantly reflect all available information. Therefore, trying to outguess the market is a fool's game. Price movements are essentially random, like coin flips. But, and this is crucial, while individual price movements are random, the pattern of those movements over time is not. They believed prices followed a predictable statistical pattern known as a bell curve. Think of the heights of all men in a country. Most will be around average height, with very few giants and very few extremely short people. The professors believed financial markets worked the same way. Most days would see small price changes, and catastrophic crashes were extremely rare statistical outliers. This led them to a profound conclusion. Risk itself could be precisely measured. The key was volatility, just a measure of how much a price has jumped around in the past. If you knew the historical volatility, you could calculate the exact odds of future price movements. They had, in their minds, banished uncertainty and replaced it with quantifiable risk. For them, investing was no longer guesswork. It was a game of odds, just like poker or blackjack. And, if you know the odds and have a small edge, you can't lose in the long run. With Merton and Scholes on board, long-term capital management was no longer just a hedge fund. It was, as one partner put it, a quote, financial technology company. They had the best finance faculty in the world. They went on a global roadshow, pitching their fund to the world's biggest banks, corporations, and even foreign governments. They promised returns of 30 or 40% a year with seemingly no risk. How? By making thousands of tiny, uncorrelated arbitrage bets all over the world. Even if one trade went wrong, the others would balance it out. The diversification was so perfect, they argued, that their portfolio was like a beautifully engineered machine. And they had another secret weapon: leverage. Leverage is like using a seesaw to lift something heavy. It multiplies your power. By borrowing massive amounts of money from banks, long-term capital management could turn a tiny profit into millions. And because of their superstar reputation, banks were tripping over themselves to lend them money on incredibly generous terms. Most borrowers have to put down collateral as security. Long-term capital management was so powerful, they convinced the biggest banks on Wall Street to lend them billions with zero collateral. They were playing with the house's money and could borrow almost without limit. In February 1994, long-term capital management opened for business with $1.25 billion, the largest hedge fund startup in history. And right away, luck was on their side. A surprise interest rate hike by the Federal Reserve sent bond markets into a tailspin. Less experienced investors panicked and started selling everything. This chaos was a gift for Merriweather. As panicked sellers ran for the exits, the price gaps between similar bonds widened to absurd levels. While other funds were losing hundreds of millions, long-term capital management calmly scooped up these mispriced assets, confident the spreads would snap back. One of their first big trades was in home mortgage securities. Their models predicted these were far too cheap, so they bought billions of dollars worth. Another huge win came from Italian government bonds, which were trading at a steep discount because traders feared Italy's chaotic politics. The models said this fear was irrational. They bet big on Italy, and the trade paid off handsomely. The results were astounding. In its first full year, 1995, the fund returned 43% to investors. The next year, 1996, another 41%. The profits were so enormous and consistent that it seemed they'd truly created a money machine. They weren't just beating the market, they were operating in a different universe. In 1996 alone, this small group of about 100 people earned over $2.1 billion in profit, more than McDonald's, Disney, or American Express. Their success bred incredible arrogance. They treated the big Wall Street banks, financing them with disdain, squeezing every last penny from every deal. They were notoriously secretive, refusing to share information about their strategies, even with their closest partners. They'd come to believe their own myth. As one partner once asked a friend, "Do you know why we make so much money? It's because we're smarter." But as their capital swelled to over $7 billion, a problem emerged. The world was running out of obvious mistakes for them to correct. The easy money in bond arbitrage was disappearing as competitors with their own computer models piled into the same trades. The spreads were becoming razor thin. So, like an army that's conquered all known territory, long-term capital management had to push into new, unfamiliar, and far riskier frontiers. They started betting on corporate mergers, a field they knew nothing about. They moved heavily into stock markets, making huge bets on pairs of related stocks, like Royal Dutch and Shell. And they made their biggest bet of all on something called equity volatility. This was the purest expression of their core philosophy. Remember how they believed market volatility always returns to its historical average? Well, in early 1998, with turmoil brewing in Asia, investors were nervous. They were paying a high price for financial insurance in the options market. This drove up the implied volatility to a level the partners considered ridiculously high. So they became the world's biggest insurance salesmen. They sold massive amounts of options, betting that the market's fear was irrational and volatility would soon fall back to normal. They were so dominant in this trade that one bank nicknamed them the quote, central bank of volatility. By the end of 1997, they had so much capital they couldn't find enough places to invest it. So they did something shocking. They forced their outside investors to take back $2.7 billion. But they didn't reduce their own massive positions. This single move dramatically increased their leverage. The partners were so confident, so convinced of their own genius, that they effectively doubled down, betting their own billion-dollar fortunes at the moment of maximum risk. The stage was set for the fall. The end came with shocking speed and violence. The trigger was a country on the other side of the world, Russia. Throughout 1998, Russia's economy was in a death spiral. But investors, including long-term capital management, kept pouring money in, convinced by a comforting belief: nuclear powers don't default. They believed the world's financial powers would never let Russia fail. On Monday, August 17, 1998, the unthinkable happened. Russia defaulted on its debt and devalued its currency. The financial loss from Russia itself was significant, but that wasn't the real damage. The Russian default shattered something far more important: confidence. It punctured the belief that there was always a safety net. Suddenly, investors everywhere were struck by a terrifying thought: if Russia can collapse, anywhere can collapse. A wave of pure, primal fear swept across global markets. It was called the flight to quality. In a panic, everyone wanted to sell anything that carried even a hint of risk: corporate bonds, mortgages, emerging market debt, and buy only the safest asset on earth: U.S. Treasury bonds. This was the perfect storm for long-term capital. Remember their basic trade? They bought riskier, less liquid bonds and sold safe Treasury bonds as a hedge. They were betting on the spreads to narrow. But now, in this global panic, every single one of those spreads exploded in the opposite direction. Their models had told them this was impossible. The trades were supposed to be uncorrelated. A loss in the mortgage market shouldn't have anything to do with a loss in Danish bonds or a merger in the United States. But their models had missed the single most powerful force in finance: the human factor. In a true panic, all correlations go to 1. When fear takes over, people don't think about statistics. They just sell everything they can. On Friday, August 21st, the dam broke. As Merriweather and most partners were on vacation, their portfolio began hemorrhaging money from every direction at once. A single corporate merger they'd bet on collapsed, costing them $150 million. Their massive bet on swap spreads went catastrophically wrong. By day's end, long-term capital had lost an astonishing $553 million. In one day, that was 15% of their entire capital. The partners rushed back to their Greenwich headquarters, their faces grim. Their models, which had predicted they were unlikely to lose more than $45 million on their worst day, had completely failed them. And this was only the beginning. The crisis fed on itself. As word of long-term capital management's troubles leaked out, rival traders on Wall Street smelled blood in the water. Knowing the fund was huge and desperate, they started intentionally betting against its known positions, a predatory practice called front-running. They drove prices down further, squeezing the life out of the wounded giant. Merriweather and his partners were now in a death spiral. Their capital was vanishing, which meant their leverage was skyrocketing to terrifying levels, over 100 to 1. They were so big they couldn't sell their positions without crashing the market even further. They were trapped. They made frantic calls trying to raise new capital. They called George Soros. They called Warren Buffett. They called every major bank, pleading for a lifeline. But no one wanted to catch a falling knife. The aura of invincibility was gone. They were no longer geniuses. They were just another failing fund. By the third week of September, they had less than $1 billion left. Their clearing broker, Bear Stearns, delivered an ultimatum: if your cash reserves fall below $500 million, we'll cut you off, effectively putting you out of business. The end was near. At this moment, the Federal Reserve, fearing a systemic meltdown, stepped in. They didn't want to use public money, but they knew that if long-term capital management failed, it would trigger a chain reaction of defaults that could cripple every major bank on Wall Street. And so we come back to that room on the 10th floor. On September 23rd, the Fed summoned the heads of Wall Street to an emergency meeting. They laid out the horrifying truth. Long-term capital management was about to collapse, and the bankers in that room, the very ones who'd recklessly lent the fund its billions, were facing catastrophic losses. The Fed's message was clear: you all created this monster together, and now you must rescue it together. After hours of tense, angry negotiations, with the titans of finance arguing over who should pay what, they finally cobbled together a $3.6 billion bailout package. 14 banks agreed to inject new capital in exchange for 90% ownership of the fund. The geniuses had lost control. Their dream of a financial empire built on pure reason was over. They were forced to hand over the keys to their kingdom to the very people they'd once looked down upon. In the space of 5 weeks, they'd lost nearly all their personal fortunes, and, more importantly, their reputations. The firm that was too smart to fail had failed in the most epic way imaginable. So what do we take away from this incredible story? It's easy to look at the partners of long-term capital management and just see greed or arrogance. And certainly, there was plenty of that. But I think the real lesson here is something deeper and far more relevant to all our lives. The story of long-term capital management is a modern Greek tragedy. It's about hubris, the dangerous pride that comes from believing you're smarter than everyone else, that you've figured out a system no one else understands. The partners weren't stupid. They were objectively brilliant. They had Nobel Prizes and PhDs, but their brilliance became their blind spot. They fell in love with their models. They believed so deeply in the elegant, rational world described by their mathematics that they forgot the world they were actually investing in, a world driven by messy, irrational, unpredictable human beings. Their models were based on history, on the assumption that the future would behave like the past. But as Mark Twain supposedly said, history doesn't repeat itself, but it often rhymes, and sometimes it throws a completely new verse at you. The Russian default was that new verse. It was an event so far outside the bounds of their historical data that their models simply broke. In their world of bell curves, it was a 10 sigma event, something so statistically rare it shouldn't happen in the entire lifetime of the universe. But it did happen. And when it did, they discovered the most important lesson in all of finance. In a crisis, all the complex math in the world doesn't matter. The only thing that matters is raw, human fear. For you, as you start your own journey in life, whether in business, science, or the arts, this story holds a powerful warning. It's a warning against the illusion of control. It's easy to believe that with enough data, enough intelligence, or a perfect plan, you can eliminate risk. But you can't. The world is, and always will be, uncertain. Life always has fat tails, those extreme, unexpected events that can change everything in an instant. The real wisdom isn't in trying to predict the future. It's in building a system robust enough to survive the future you can't predict. It's about humility. It's about understanding that you might be wrong and preparing for that possibility. The partners at long-term capital management used so much leverage that they left themselves no room for error. A single serious mistake was enough to wipe them out. So as you build your own life and career, remember the geniuses of Greenwich. Remember their spectacular rise and even more spectacular fall. Let their story be a constant reminder to stay humble, to respect the power of uncertainty, and to never, ever believe you're too smart to fail. That was the story of When Genius Failed by Roger Lowenstein. We've journeyed through the dizzying heights and devastating lows today, but I'll be honest, a summary can only scratch the surface. The real power of this book is in the details, the personalities, the tense conversations, the tick-tock of the crisis as it unfolds. It reads less like a business book and more like a financial thriller. If anything we've talked about has sparked your curiosity, I truly encourage you to grab a copy. Reading it isn't just about learning financial history. It's about understanding the timeless flaws of human nature that echo in every field of life. You can find a link to the book in the description below. Also, if you found this summary valuable and it gave you something to think about, please hit that subscribe button. It lets me know these stories matter, and it ensures you won't miss our next exploration into another transformative book that shaped the minds of the world's most successful people. Let's keep learning and growing together.